Before we discuss this learning objective, I'd like you to look at the solution for problem 3-1b, where we recorded Hyman Company transactions using a tabular summary. Here's the solution. This analysis might work well for a small company that had only several transactions. But as a business expands, this method would not be sufficient for recording transactions. We need a formal structure or way to enter the transactions into the accounting system. This will involve accounts, debits, and credits. An accounting information system uses accounts. An account is an individual accounting record of increases and decreases in a specific asset, liability, stockholders' equity, revenue, or expense item. So companies have separate accounts for cash, accounts receivable, accounts payable, service revenue, rent expense, and so on. Please have your chart of accounts handy to make sure you use the correct account titles. Do not use phrases such as paid cash, bought supplies, or performed services as account titles. In its simplest form, an account consists of three parts: the title of the account, a left or debit side, and a right or credit side. Because the alignment of these parts of an account resemble the letter T, it is referred to as a T account. The term debit, or DR for short, indicates the left side of an account, whereas credit, or CR for short, indicates the right side of the account. When comparing the totals of the two sides, an account shows a debit balance if the total of the debit amounts exceeds the credits. The balance is determined by netting the two sides, subtracting one amount from the other. If the debits total $18,000 and the credits are $3,000, the balance in this account is $15,000. An account shows a credit balance if the credit amounts exceed the debits. The balance is determined by netting the two sides, subtracting one amount from the other. If we have credits of $11,000 and debits of $10,000, we're going to have a $1,000 credit balance. The procedure of recording debits and credits in Hyman's cash account is provided on this slide. The data was taken from the cash column of Hyman's tabular summary. Every positive item in the summary represents receipts of cash, whereas every negative amount represents a payment of cash. Notice that in the account form, we record the increases in cash as debits and the decreases in cash as credits. For example, the $300,000 receipt of cash, it's noted in blue, is debited to cash, and the $10,000 payment of cash, in red, is credited to cash. Having increases on one side and decreases on the other reduces recording errors and helps in determining the account balance. The balance is determined by netting the two sides, subtracting one amount from the other. The debits total $39,000, whereas the credits are $12,640. The account balance, a debit of $26,360, represents the balance in its cash account. Each transaction must affect two or more accounts to keep the basic accounting equation in balance. If every transaction is recorded with equal debits and credits, then the sum of all the debits to the accounts must equal the sum of all the credits. The double entry system is much more efficient than the plus or minus procedure used earlier. Again, if we go back to Hyman in that first transaction where we had shareholders invested $30,000 of cash in the company in exchange for common stock, and we said that cash was increasing and common stock was increasing, right? How we would get this into our accounting system is we would simply debit cash for $30,000 and credit common stock for $30,000. Assets are on the left side of the equation and they will increase with debits, left side of the T account. Whereas liabilities and stockholders' equity are on the right side of the equation and they will increase with credits, or the right side of the T account. Revenues increase retained earnings, so they will increase with credits, whereas expenses and dividends decrease retained earnings, so they will increase with debits. This image summarizes the debit and credit rules and the effects on each type of account. Study this diagram carefully. It will help you understand the fundamentals of the double entry system. No matter what the transaction, total debits must equal total credits in order to keep the accounting equation in balance. For Haynes Corporation, increases in cash and asset were entered on the left side, and decreases in cash were entered on the right side. Increases and decreases in liability have to be recorded opposite from increases and decreases in assets. So increases in liabilities are entered on the right or the credit side, and decreases in liabilities are entered on the left or the debit side. Asset accounts normally show debit balances, and liability accounts normally show credit balances. Knowing which is the normal balance in an account may help you when you're trying to identify errors. For example, a credit balance in an asset account such as land, or a debit balance in a liability account such as accounts payable, usually indicates errors in recording. However, an abnormal balance may be correct. For example, the cash account will have a credit balance when a company has overdrawn its bank balance by spending more than it has in its account. In previous chapters, you learned that stockholders' equity is comprised of two parts, common stock and retained earnings. In the transaction events earlier in this chapter, you saw that revenues, expenses, and the payment of dividends affect retained earnings. Common stock is issued to investors in exchange for the stockholder's investment. The common stock account is increased by credits and decreased by debits. For example, when cash is invested in the business, cash is debited and common stock is credited. Retained earnings represents the portion of net income that has been retained or reinvested in the business. Retained earnings is increased by credits, or net income, and decreased by debits, or a net loss. A dividend is a distribution by a corporation to its stockholders. The most common form of distribution is a cash dividend. Dividends reduce stockholders' equity, so increases in the dividend account are recorded with debits. When a company recognizes revenue, stockholders' equity is increased. Revenue accounts are increased by credits and decreased by debits. Expenses decrease stockholders' equity, so expense accounts are increased by debits and decreased by credits. The effect of debits and credits on revenue and expense accounts is the same as their effect on stockholders' equity. Revenue accounts normally show credit balances, and expense accounts normally show debit balances. To review, revenue and expenses are reported on the income statement. Dividends, revenues, and expenses are eventually transferred to retained earnings at the end of the period. As a result, any change in any one of these three items affects stockholders' equity. To summarize, assets are on the left side of the equation and increase with debits, left side of the T account. Liabilities and stockholders' equity are on the right side of the equation, and they increase with credits, right side of the T account. The effect of debits and credits on revenue, expense, and dividend accounts are the same as their effect on stockholders' equity. This is an alternative to the expanded equation model that summarizes debit and credit rules. The normal balance of an account is on the side where an increase in the account is recorded. Study this diagram or the other one carefully. You can also use the acronym DED, where D represents debits, E represents expenses, A assets, and D dividends. So debits are the normal balance for expenses, assets, and dividends. And that means that those accounts will increase with debits and decrease with credits. Let's revisit Hyman and convert this tabular summary to journal entries. For example, increases in cash and asset result in debits, and decreases in cash result in credits. That first transaction, we have an increase in cash of $30,000, so we're going to debit cash for $30,000 and credit common stock. In the second transaction, we have cash going down or decreasing. So in this instance, we're actually going to debit equipment and credit cash. In transaction number 3, they paid cash for their rent. So I want you to debit rent expense and credit cash. They also, in transaction 4, they purchased supplies. So I want you to debit supplies and credit cash. Transaction number 5, they are purchasing advertising, and it is on account. So you're going to debit advertising expense. We're going to actually credit accounts payable. Again, we didn't pay for it in cash, but we will pay for it, most likely within the next 30 days. The next transaction is we received cash from a customer for services. Again, I want you to debit cash and credit service revenue for $8,000. In the next transaction, they paid a cash dividend of $500. You're going to debit dividends and credit cash. They paid their employees $1,000. Again, you're going to debit salary and wage expense and credit cash. They paid a utility bill, so we're going to debit utility expense and credit cash. And let me see, they performed services on account. Again, that's going to result in a receivable because it was on account. And we're also going to recognize revenue in the amount of $2,000. And lastly, they collected cash for services billed in the previous transaction. We're going to debit cash for $1,000. They only collected $1,000. And then credit accounts receivable.